Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at AST SpaceMobile.
If you find our talks useful, please consider subscribe, like, and comment underneath.
And a quick note before we get into today's stock. If you need emergency cash and want to look at a short-term installment loan option, you can check out MaxLend Loans through my link below. Eligible customers may qualify for loan options up to $3,750, and funding may be available quickly if approved. But please be careful. Always read the full loan agreement, APR, fees, repayment schedule, and total cost before signing anything.
All right, let's jump right in. So just imagine for a second that you are like miles and miles away from civilization.
Okay, setting the scene.
Yeah. So you're hiking in the middle of a super dense, rugged national park. Or, I don't know, maybe you're sailing hundreds of miles offshore, right? Totally beyond the reach of any cell tower.
Definitely no Wi-Fi out there.
Yeah, right, zero. And you pull out your phone, just your completely unmodified everyday smartphone, no bulky satellite attachments bolted to the back, no special antennas you have to point at the sky to get a signal.
It's just a regular phone.
Just your regular phone. You look at your screen and you suddenly have broadband speed internet.
Wow.
Yeah. We're talking like 120 megabits per second beaming directly to the device in the palm of your hand from space.
I mean, it genuinely sounds like science fiction, right? Like something out of a movie.
It really does.
But what is so fascinating right now is that this is, it's rapidly crossing the threshold from just being a theoretical pitch deck into an actual operational reality. We are finally moving past that initial hype phase of space infrastructure.
All right, let's move into the wealth building context.
Yeah.
Because this transition period is huge, right?
Oh, absolutely. If we connect this to the bigger picture of how infrastructure is built, there's a very specific life cycle you have to understand to see where the wealth is actually generated. Whether we're talking about laying the first transatlantic fiber optic cables across the ocean floor or, erecting the first global cell tower networks, like the initial capital requirements are just brutal.
It's a cash furnace for years.
Yeah.
I mean, you are pouring billions of dollars into a hole, or, well, in this case, into the sky, and getting absolutely zero revenue back while you build it.
Exactly. And honestly, that phase terrifies a lot of people. It's risky. But once that infrastructure is in place and the switch is finally flipped,
then what happens?
The operating margins become extraordinary because the heavy lifting is done. You're just maintaining it. So the transition from building the infrastructure to actually monetizing it is a critical inflection point.
You're taking on the risk of the build-out phase coming to an end with the goal of, capturing the upside when the operational phase finally kicks in.
Precisely. You want to be there right when they turn the tap on.
Though, I guess we should say, the downside risk is absolute. If those rockets don't work or the satellites fail to deploy in orbit, the equity can literally go to zero overnight.
Right, which requires a very specific iron stomach kind of mindset to invest in a company like this.
So you really have to rely on the data, not just the cool space hype.
Always the data.
Now let's look at the fundamentals. Because logically, before we even look at the giant satellites themselves, we have to start with the lifeblood of any massive infrastructure project.
The money.
The money. Let's talk about the revenue explosion, because AST SpaceMobile just hit a massive milestone.
It really did.
For the full year of 2025, they reported $70.9 million in revenue. Now, I know that might not sound like a world-dominating number to some people yet, but context is everything here.
Right, compared to the previous year.
Exactly. In 2024, they brought in just $4.4 million.
That is a staggering jump. The acceleration is what matters here, particularly the pacing of how that money came in.
Yeah, because the bulk of that $70.9 million came almost entirely in the fourth quarter. They hit $54.3 million in Q4 alone, which completely crushed Wall Street's consensus estimates. Analysts were sitting way down around $39.5 million.
They totally blew past that.
It's like they've been out in the desert digging trenches and laying pipes for 5 years, just sweating through massive capital expenditures. And then in Q4, someone finally reached over and turned the water on.
That is a perfect analogy. And the breakdown of that Q4 revenue is super telling, too. We saw $44.4 million in product revenue, which was driven largely by the delivery of 15 commercial gateways, and another $26.5 million in actual services revenue. However, to your earlier point about the cash furnace, we do have to look at the bottom line.
Right, the actual losses.
Right. GAAP net loss, meaning the actual accounting loss, when you factor in every single expense that actually widened to over $341 million in 2025.
Okay, let's pause there for a second, because a $341 million net loss, that usually sets off massive alarm bells for anyone looking at a stock.
Oh, for sure. It sounds terrifying.
Yeah. I mean, if you are burning that much cash, how are the lights still on? How is the company surviving that kind of burn rate without just going straight bankrupt?
Because behind the scenes, they have successfully de-risked the balance sheet.
Okay, how so?
This is arguably the most crucial fundamental shift in the company's recent history. As of the end of 2025, their pro forma liquidity, essentially the total cash and accessible capital they have on hand, sits at approximately $3.9 billion.
Wait, $3.9 billion?
Yep, $3.9 billion.
Wow. So they essentially raised this massive war chest just to guarantee their survival.
It's a fortress balance sheet now. That $3.9 billion includes a $1.075 billion convertible senior notes offering that they just closed in February of 2026.
Okay.
And they also use this financial maneuvering to optimize their capital structure by equitizing older notes.
Let me stop you there, because for those of us who don't, read balance sheets for fun on the weekends, equitizing older notes just means they paid off some of their older debt by giving those lenders stock instead of cash, right?
That's exactly what it means.
But wait, handing out stock sounds easy, but doesn't that bring up the biggest historical risk of holding this stock? Like the dilution?
Yes, dilution is the boogeyman here.
Because if a company is constantly printing new shares of stock to pay its bills or pay off its lenders, it dilutes the value of the shares that regular investors hold.
Right.
It's like pouring water into a glass of wine to make it last longer.
Yeah.
Eventually, you just have watery wine and nobody wants to drink it.
And AST has historically been a very, very watery glass of wine.
Yeah.
Oh, yeah. Over the past 5 years, their shares outstanding jumped by 437%.
Yikes.
They were constantly issuing new shares just to keep the project alive. And obviously, that destroys shareholder value over time. But here's the pivot. This new $3.9 billion liquidity position totally changes the game.
Because they have the cash now.
Exactly. It fully funds the construction of their upcoming Block 2 constellation. The historical risk of crippling dilution is effectively mitigated now because the build-out is finally fully capitalized.
So they don't need to keep going back to the well to ask for more money.
Right.
And because that funding is secured, the future projections from analysts are almost startling. Like they expect adjusted EBITDA, basically the core operating profitability, to turn positive in 2027 and actually hit $1.26 billion by 2028.
That is the power of the infrastructure model we discussed earlier. Once the capital expenditure is funded, those software-like margins just kick in.
Right.
But of course, that money actually has to build something tangible.
Right. That brings us to the catalyst timeline.
Yeah.
Because we have to talk about what they're actually putting into space.
The hardware.
And hardware almost feels like too small a word for what they're building here. We are talking about the Block 2 Bluebird satellites.
These are massive.
Yeah, these are not the size of a microwave or a dorm room mini fridge like some of the older communication satellites you might picture. These feature 2,400 square foot phased arrays.
Just to help you visualize that 2,400 square feet.
That is the size of a very comfortable 4-bedroom suburban house.
Easily.
But instead of sitting on a cul-de-sac, it is being shot into a vacuum and unfolding itself in low Earth orbit. How do you even fit a house into a rocket fairing?
It requires incredible mechanical engineering.
Yeah.
The arrays are folded up like highly, highly complex origami.
Okay.
Once the satellite is deployed from the rocket, it uses this series of hinges and tension systems to slowly unfurl this massive flat surface area in zero gravity.
That sounds nerve-wracking.
It is.
All right.
But that sheer size is the whole point. That massive surface area is what gives a single Bluebird roughly 100 times the capacity of a Starlink direct-to-cell satellite.
Wow. 100 times.
Yes. You need that massive footprint in space to act like a giant ear, basically listening for the relatively weak signal coming from the tiny antenna inside your everyday, unmodified iPhone or Android.
Hold on, though. You just mentioned Starlink, and that brings up a really obvious question for anyone following the space sector.
Sure.
Starlink already has, what, 10 million monthly users on its direct-to-cell service?
Yeah. roughly.
On top of that, Amazon just bought Globalstar to enter this exact same space.
Yeah.
So we have Elon Musk and Jeff Bezos throwing literal billions at the same problem. Isn't AST SpaceMobile just fundamentally too late to the party?
That is the single most common critique from observers looking at this sector, but it fundamentally misunderstands AST's unique competitive moat.
How so?
AST is not fighting Starlink or Amazon for individual consumer subscriptions. They are not running ads trying to get you to cancel your current cell phone plan and sign up for an AST network.
So what are they actually doing then?
They operate on a B2B2C model, business to consumer.
Wait, so if they are partnering with terrestrial companies, instead of competing with them, they aren't trying to steal Verizon's customers.
Right.
They're basically just becoming Verizon's new cell tower in the sky.
That is the exact mechanism. They've partnered with over 50 mobile network operators worldwide. We are talking about the undisputed terrestrial giants here, AT&T, Verizon, Vodafone.
The heavy hitters.
Exactly. Collectively, these partners already have nearly 3 billion existing subscribers globally. 3 billion.
That's a massive built-in customer base.
AST currently has over $1.2 billion in contracted revenue commitments from these partners, which actually includes a massive $175 million prepayment from State Group.
Okay, that is a brilliant way to sidestep the consumer marketing war. The telecom giants actually have equity exposure to AST. They want this to succeed because it extends their own coverage maps without them having to figure out how to build cell towers in the middle of the ocean or at the peak of a mountain range.
Exactly. And that strategic partnership brings us to what is arguably their strongest protective moat of all regulation.
The red tape.
The red tape. AST recently secured authorization from the FCC to operate a 248 satellite constellation. But the critical detail here is the spectrum they are allowed to use.
Okay, why does the spectrum matter?
Because of their partnerships, they are authorized to use the low-band spectrum owned by incumbents like AT&T and Verizon.
Why does low-band spectrum matter so much more than what Starlink or Amazon might use?
It comes down to the physics of radio waves. Low-band spectrum has a much longer wavelength.
Let me see if I can translate that. Think of high-band spectrum like a laser pointer, right? It has incredible fast line-of-sight energy, but if you put a single piece of paper in front of it, the signal is totally blocked.
Right.
Whereas low-band spectrum is more like the deep bass from your neighbor's stereo.
Yeah.
You can't see it, but it punches right through the walls, right through the trees, and through heavy rain.
That is a fantastic analogy. Starlink currently relies on PCS spectrum, which is a higher band. It doesn't have those same deep penetration characteristics. So if you are under heavy foliage or inside a building, low band is vastly superior for keeping a phone connected. Furthermore, Starlink does not currently enjoy the same regulatory shield in the United States for this specific incumbent licensing structure.
So AST has built this structural regulatory moat that new entrants simply cannot replicate overnight. It doesn't matter how much money Bezos or Musk throws at the problem, right? They can't just invent new spectrum laws or instantly absorb AT&T spectrum rights.
Precisely. The competitive advantage is totally baked into the legal and physical framework of their partnerships.
Now let's pivot to the chart. Because the financial runway is clear, the tech is massive, and the partnerships are locked in, but we have to look at how the real world, specifically the stock market, is reacting to all of this.
Right.
Because it hasn't exactly been a smooth upward line on the chart.
Far from it. As of early May 2026, the stock has been in a clear correction phase. It is trading below its 20-day, 50-day, and 200-day moving averages.
That sounds rough.
Yeah, it's currently sitting near a key psychological pivot area of $66.50. It has been a turbulent ride for investors trying to hold through the volatility.
A lot of that recent downward pressure wasn't even related to the company's operational performance, though, right? It was driven by structural market mechanics.
I'm talking about the Rakuten news.
Ah, yes, Rakuten.
Rakuten, which was a major early backer, recently sold a massive block of 4.5 million shares.
Which naturally spooked a lot of retail investors.
Yeah, I mean, if someone dumps 4.5 million shares onto the open market, doesn't that usually mean they know something terrible and are fleeing the burning building? Like, why shouldn't the listener be worried?
It is a totally valid concern.
Yeah.
But you have to look deeper at how the market actually absorbed that supply. In institutional trading, a known large seller who is slowly offloading shares is called an overhang. An overhang. So it basically acts like a wet blanket on the stock price. Every time the stock tries to rally, this giant seller is there saying, great, the price is up. I'm going to sell another 100,000 shares, which immediately pushes the price back down.
Exactly. It suppresses any upward momentum. But what happened here was that the market rapidly absorbed that entire 4.5 million share block at once.
Oh, wow.
Yeah. By clearing that block out entirely, the structural overhang was completely removed. The wet blanket was lifted.
And we saw the proof of that resilience almost immediately, didn't we? Once that selling pressure was gone, the stock surged 14.8%, up to $75.05, just on the news of a new launch partnership with SpaceX.
That aggressive bounce tells you a lot about the underlying demand. Institutions and retail investors are aggressively bullish when operational catalysts are confirmed. They were really just waiting on the sidelines for that Rakuten supply to clear the order books before stepping back in.
So what does market sentiment look like beyond the chart?
Well, Wall Street analysts are finally waking up to the revenue jump. UBS recently raised their target to $85, and even Barclays, which has historically been quite bearish and maintains an underweight rating, they were forced to raise their target to 65 just based on the sheer execution of that Q4 revenue beat.
That's pretty telling when the bears start raising their targets.
Definitely.
But beyond the hard numbers, there is a highly speculative, wild rumor-driving sentiment right now.
Okay, this is fascinating. Let's unpack this. The rumor circulating the market is that these massive 2,400 square foot phased arrays might not just be used for beaming cell service.
Right.
They could potentially be utilized for space-based artificial intelligence and edge computing data centers.
From an engineering perspective, it actually solves massive terrestrial problems.
How so?
Data centers on Earth are facing an existential crisis regarding resources. They require mind-boggling amounts of electricity to run the AI servers and massive amounts of water and energy just to keep the servers from literally melting down. But in low Earth orbit, the environment naturally solves both of those problems, right? The ambient temperature of space can handle the heat dissipation, and you have uninterrupted 24/7 access to pure solar power.
Exactly. Now, it is highly speculative right now. There is no official press release confirming a space data center pivot.
Sure.
But the underlying logic is what has investors so excited. If space-based edge computing becomes a necessity for the next generation of AI, AST SpaceMobile is one of the only companies with the physical footprint, these massive arrays already in orbit to facilitate it. It adds a tremendous amount of optionality to the company's future narrative.
It's the ultimate what-if upside.
It really is.
Now let's talk about the risks.
Yeah.
Because in the space sector, we have to bring this back down to Earth, literally. The risks aren't just about missing a quarterly sales target. The risks are catastrophic.
The single biggest vulnerability this company faces is gravity.
Yeah, you can have the best proprietary technology in the world, $3.9 billion sitting in the bank, contracts with every major telecom on Earth, and full FCC approval.
Right.
But if the rocket blows up on the launch pad, none of it matters.
The bull thesis relies entirely on a flawless launch cadence, and we have seen this vulnerability materialize recently. We have to remember the loss of the Bluebird 7 satellite.
That was tough.
It was lost due to a deployment failure on a New Glenn rocket. On top of that, the company missed a critical orbital milestone back in February.
Launching things into a vacuum is incredibly difficult. Every delay burns through their cash runway and pushes that magical 2027 revenue projection further into the future.
Which brings us to the upcoming dates.
Right. They've got the May 11th earnings report coming up, where the risk of an upside surprise is high, given what we saw in Q4. But more importantly, the most critical date on the calendar, the mid-June crucible.
Yes. In mid-June 2026, AST is scheduled for a SpaceX Falcon 9 launch carrying 3 of these new Block 2 Bluebird satellites. This is, without question, the most critical near-term operational catalyst for the company.
Why is this specific launch the make-or-break moment? Like, why 3 satellites?
It comes down to the math required to build the constellation. If this mid-June launch slips, or if there is an anomaly during deployment, they will mathematically miss their target of having 45 satellites in orbit by the end of the year.
And 45 is the magic number.
Exactly. The 45 satellite threshold is what enables continuous global coverage. If they have fewer than 45, there are gaps in the network.
And if there are gaps, the service drops.
Right. If there are gaps, they can't offer the seamless service their partners are paying for. If continuous coverage is delayed, that projected 2027 revenue timeline, that massive $1 billion ramp-up everyone is expecting, gets totally destroyed.
And the window of opportunity isn't going to stay open forever. Competitors are scaling. While AST has a strong FCC moat right now, a 2-year delay in launching their own constellation could give Amazon or Starlink enough time to aggressively lobby for a regulatory shift or, improve their own hardware to close the technology gap.
The execution risk is paramount here. Now, the transition to using SpaceX for this upcoming launch does mitigate some of the launch vehicle risk, as the Falcon 9 is the most reliable workhorse in aerospace history.
Sure.
But getting to space is only half the battle. The deployment of those massive 2,400 square foot origami arrays in a zero-gravity vacuum still has to go flawlessly.
So with everything on the table, what's the final verdict? We've got the $3.9 billion war chest, the massive Q4 revenue beat, the terrestrial partnerships, the Rakuten overhang clearing, and the very real threat of a rocket failure in June.
Well, based on the fundamental analysis, particularly their deeply entrenched B2B2C moat and the complete resolution of their immediate liquidity concerns, the underlying research assigns AST SpaceMobile a bullish score of 7 out of 10.
A 7 out of 10.
Yeah.
That feels like a score that perfectly reflects the massive generational upside potential, heavily balanced against the binary risk of a launch failure.
Exactly. They are currently the only pure-play infrastructure provider offering broadband class, direct-to-device connectivity to completely unmodified smartphones. They have the war chest, they have the irreplaceable network of over 50 mobile operator partners, and they have the spectrum authorization.
So what's the time frame here?
The target horizon here is a long-term, multi-year hold, specifically looking at an 18 to 24-month time frame. The thesis is to position yourself now, while the stock is navigating these operational hurdles, to capture that expected 2027 commercial inflection.
It is a high-wire act, but the safety net of their balance sheet is finally in place. As we wrap up this deep dive, I want to leave you with a broader philosophical question to ponder. For over a century, our entire telecommunications infrastructure has been stubbornly bound to the Earth.
Right, wires everywhere.
Exactly. Cables buried in the ground, steel towers built on hillsides. It has always been vulnerable to natural disasters, bound by arbitrary terrestrial borders, and controlled by regional monopolies.
That's just how it's always been.
But as this infrastructure literally leaves the Earth's surface to become globally ubiquitous, immune to hurricanes, earthquakes, and local politics, how will that fundamentally shift the balance of power?
It's a huge shift.
Will the traditional telecom monopolies maintain their iron grip by partnering with companies like AST, or are we witnessing the birth of a totally new era, ruled entirely by the new lords of low Earth orbit? Think about that the next time you look at the bars on your phone. Need emergency cash? MaxLend Loans offers short-term installment loan options up to $3,750 for eligible customers. Apply through the link below and carefully review the APR, fees, repayment terms, and total cost before accepting any offer.
And if this episode helped you, please subscribe, like, and comment underneath. We'll see you in the next Smart Wealth with the Joshua episode.